Here's what most people get wrong about wealth. They think it takes a huge paycheck to build real money. It doesn't. A 25-year-old investing just 500 rupees a month will have more wealth at 65 than someone who waits until they're 30 and invests 5,000 rupees monthly. Same money, different timeline, completely different outcome. This isn't magic. It's compound growth, and it's the most powerful wealth-building tool you have access to right now. Let me show you the actual math, because numbers don't lie. If you're 20 and invest just 500 rupees monthly at a 12% annual return, which is historically what the stock market for beginners delivers, by age 65, you'll have approximately 1.2 crore rupees. That's from investing just 2 lakhs total. But if you wait until 30 and invest 5,000 rupees monthly, you get only 70 lakhs by 60. You're investing 5 times more money, but getting 80% less wealth. That's the power of starting early, and it's non-negotiable. So why does almost nobody do this? Because your brain is wired for immediate rewards, not future ones. Losing 500 rupees today feels real. Gaining 1.2 crore in 40 years feels abstract. This is where money habits matter more than money itself. Rich people train themselves to feel the future as vividly as the present. They automate investments so their brain never gets a vote. Set it up right now. Automatic transfers on payday, and you've solved 80% of the problem. Now, let's talk about the actual tax-efficient strategies that build wealth faster. First, max out tax-advantaged accounts. In most countries, retirement accounts like a 401k or equivalent let you invest pre-tax money. That means if you earn 10 lakhs and invest 2 lakhs in your retirement account, you only pay tax on 8 lakhs. That's free money from the government, basically a tax refund built into your investing tips strategy. Most beginners leave this money on the table because nobody explained it clearly. Second, diversify across investment types. Stocks give you compound growth, but bonds and real estate give you tax efficiency. When you mix them strategically, 70% stocks, 20% bonds, 10% alternatives, you're not just reducing risk, you're optimizing your tax bill. This is what personal finance advice from actual wealth builders looks like. It's not exciting. It's boring. And boring wins every single time in money. Third, understand index funds versus active trading. 90% of active traders lose money after taxes and fees. Index funds, which track the entire market, beat them consistently. Why? Because you're paying almost zero fees, which means more money stays invested. Less money leaving your account means more compound growth. More compound growth means wealth. It's that simple. This is how to invest in share market like someone with financial intelligence, not like someone trying to get rich quick. Here's your first action step. Open a tax-advantaged investment account today if you don't have one. Then automate a deposit, even if it's just 200 rupees, for next week. Don't overthink the amount. The number one reason people fail isn't because they don't know what to do. It's because they don't start. Start imperfectly today, rather than perfectly never. Your 25-year-old self will thank you more than you can possibly imagine right now. The difference between the wealthy and everyone else isn't intelligence or luck. It's starting early, staying boring, and letting math do the heavy lifting. If you found this breakdown valuable, smash that like button and subscribe for weekly personal finance advice that actually changes your numbers. This is the kind of content that moves you forward. No hype, just real strategies that work. Let's build something real together.